familiar way of how some of the rallies in the trading range developed. And as we are reacting to one half of the range, and on the next rally, we are attempting to overcome the point of upsloping resistance. We see that there is only a temporary commitment to the upside. There is only one bar, one close that is above the previous high. And then the price just quickly fails back into the trading range. So therefore, a question here is, why would this happen? What if the stock is so strong, why is it failing on the breakout? And we obviously could see that as the price goes back into the trading range, there is a gap, there is a down spread that is increasing, and also supply is increasing. Those are all elements of potential institutional selling. So we want to make sure that we are not necessarily shorting a leadership stock right away. There were so many other stocks to short before that, even before October and September, that were already in the downtrend. If you look at some of the stocks, even if we look at Russell, look at the September action compared to other indices and other stocks, you could see that stocks in Russell 2000 have been exhibiting already the weakness. So on the first leg to the downside, this is where you have to be. You have to be in the weaker asset. But as I was actually conducting a presentation for StockCharts.com on MarketWatchers Live, I actually had this position. And I've entered this position on the second leg to the downside. This was the actual bar where I've initiated this position. And this type of the positions I always conduct with options trading. So I just bought directional options with, and I have to look it up a little bit better, what was the expiration. But usually for this type of short-term trades, I would have the expiration a month or two away. I'm expecting a drop to the downside, and I'll explain in a second why. But first, let's talk about the timing. Let's talk about the selection. How do we transition from a leadership stock into the stock that is for sale and into the stock that we could short with confidence? Well, this whole move right here, look what happens here. It's a change of character. The stock is starting to behave in a different way. We're seeing multiple gaps at the open. We're seeing how the down spread is increasing. And comparing this move to the previous moves to the downside in the same trading range, this is probably the most aggressive move to the downside. Not only that, look at the distance that it traveled. This is the largest distance to the downside in this trading range. So if they sell, they actually progress to the downside. We will be discussing in the second portion of the course the relationship between volume and price, or as we would identify it in different terms, the relationship between effort and the result. So we're seeing for the first time that all of the attempts to push the price down in the trading range were unsuccessful. And for the first time, not only the distance of the reaction has increased and the character with which it moves, but also we are seeing the increase of the supply signature, or rather increase of the downward effort. And it's being synchronized with the downward result. And that's what we're looking for in the selection of the stock that has concluded some kind of formation and now shows to us that institutions are selling at this point. So that was the determining factor for the selection of this trade. Everything else was kind of very much mechanical, because tactics are tactics. They're not going to change. We're identifying the first leg to the downside as a sign of weakness, and then look at the rally. A very weak rally. It cannot even come back to 1/2 of the trading range, and then it just fails. So the position was opened on this bar right at the open after the price went through the previous low, and it was an enjoyable trade just because it happened so fast. So from about 236, to 188, that's about what? So almost like $50. And it happens so quick. 1, 2, 3, 4, 5, 6, 7 days, 7 trading days. So a week and a half. And let's see, if you are a swing trader and a short-term swing trader, this is a very quick profit. And also think about the leverage, right? So I'm putting on puts options. So I'm definitely leveraging this position. Now, the reason for closing the position was that we have made a lower low below the low of the automatic reaction. And we are clearly in the oversold condition here. The volume signature is not that climactic, but we're anticipating that at this point, we might have some kind of stopping action. Why? Well, because selling does not happen consistently. There is always some kind of institutions that are going to find some value as the price moves to the downside. Because if they are holding their position and they are thinking, well, Novadea was a leadership, even in this climate, I'd rather hold on to this stock because it's a leadership stock, then at some point, as the price goes to below the point of where they bought or they thought that there is some value, they're going to step in and they're going to start buying. And we see that from the volume signature. So a lot of the conversations that we're going to have throughout this course is going to be about institutional sentiment. Where do they find value? And where do they find liquidity? Those are the two things that institutions require in order for us to they require in order for them to open the position. So increasing the volume signature suggests increasing the institutional activity. And we see that there was a move to the upside. So some of them were buyers at this point. There was no reason for me to wait for a potential trading range to develop. That was the thought at the time. So the exit was just at the close. And initially, I thought that my analysis was correct. And I thought that after the selling climax and automatic rally, we had a secondary test, and we are in phase A, and we're going to continue a trading range until the next leg to the downside as a continuation. Unfortunately, it didn't happen that way. The price just tanked, and it tanked on the institutional capitulation. This is where institutions are just giving up their positions. And we must say that there is a difference between a strong hand or a weak hand. There is, institutions that are acting at this point of time as strong hands, and some institutions are acting as weak hands. So obviously, capitulation happens on the selling of weak institutional hands. And then some of the strong hands that are seeing that there is some value that was not there for them at 190, 180, but they've seen some value at 150, 140, 130. So they are stepping in and they're stopping the price from moving further down by initiating their buy positions. So that was a relatively easy and quick trade, emotionally very stable because the price basically drops, and that's how it usually happens during the bear market. And I really enjoy actually shorting. It's just that we haven't had an opportunity to short for quite some time, and I don't mean just short, specific stocks, but market in general. talking about the market. So as we are continuing with the development of the bearish sentiment, in this area right here, I had quite a few calls to the upside, and I'm actually totally okay with that. There are two things that you have to remember. It's all about the context of where we are and how we trade. And the context here is that as we have already established, let's say, a bias to the downside, it doesn't mean that there are no trades to the upside that we could exploit, even on a short-term basis. So as the market was going down in the second leg right here, we could see that the supply is actually being exhausted. And my call here was to the upside, and I still stand by that. And I thought it was a great call because the call was just for a swing trade or for the rally to happen. And actually, it happens, a couple of times actually on other markets, on other indices, that was even better. So I'm going to show you some of the trades in this area right here if you're a swing trader, and how to exploit that. But in this case, a continuation happened after a failed sprint. And we'll talk about the sprint and the definition of the sprint later on, guys, so don't worry about that. But it acted as a failed signal. And a failed signal is probably the best signal in technical analysis that you could find. Why, Bill? Because usually a failed signal will have a very quick shift in the sentiment where the majority of traders were on the wrong side of the trade. And then as they close out their positions, either via stop loss or capitulation, that produces a big counter move to the sentiment that preceded that. And we kind of see that it happened exactly this way. Well, first of all, we are coming out of the apex formation. So here we're thinking that the velocity is going to increase on the way down, if the sprint fails. And as it fails, it gives us a very, very great tactical place to open the position, which obviously I took advantage of. And not necessarily was the best exit right here. And, I think that further down the road, we could discuss this, whether in the Wyckoff Trading course or in the practicum. But I still felt that it was much better than not to be exposed to the market at the time when the bias was so bearish. That's number one. Secondly, at the time I had some long positions, which were campaign positions or even swing positions, and I wanted to hedge. So one of the ways to do that is exactly this. You could hedge through opening the position, let's say against some of the positions that you have with the different buys, and that was the idea, and it worked out somewhat okay, somewhat perfectly. I'm just kind of thinking more about the exit here. My preference would be to exit a little bit lower right here on this close. Why? Well, because this shows to us, this bar shows on the volume signature a climactic action. So this was more truer selling climax characteristic than on the previous bar. And the reason why I was thinking, now I'm remembering this, is just the close that had a little bit of the uplift and that we didn't really experience before that. So I remember that was the thinking. Also, look at the oversold condition right here. Even this bar, the exit bar, has been already in the oversold condition. And so therefore, and the volume signature was relatively high. It was one of the highest that we have had. And if we use the analog of how the price actually stops here, there was a suggestion that somewhere here there might be a stop in action. So that was the logic. But definitely could have been a little bit better as an exit. So these are the couple of trades that I've conducted during this bear market. But as I've mentioned, there were some trades that I had on the long side, and I definitely want to acknowledge that. That's number one. I want to explain the logic. I want you guys to understand the logic. So we'll go through that, and hopefully, after this post-analysis, you kind of would get a feel of, first, how I trade, secondly, what I teach, and thirdly, and more importantly, how could we use Wyckoff methodology to define the selection and to define the tactics for us. A question here from Eric. After the sign of weakness to the exit at 188 is better not to operate? Was that the question, Eric? Okay, so after the sign of weakness to the exit of 188. Okay, better not to operate? I don't know, it worked out, right? So I think what happened here is that institutions started to sell, and there was not a lot of selling, actually. If you think about, what this move to the downside, what it had in terms of the force to the downside, we could see the increase in the supply signature. But if we would compare it to the previous attempts, to sell off, it actually was less of a force to the downside. Yet, look at how quickly we move into the downside. So it means that there is no resistance for the price to stop at some point and to react to the upside. There are no bias at this point. So that was the logic of the continuation. Okay, and Eric, hopefully I understood your question. If not, you could just re-ask. Let's look at the next case study. And this one is a Canadian Solar. This particular stock I have been stocking for some time. And I'm going to go through the analysis first to the point of entry so that you would understand the logic of why I'm in this position. I'm still currently in this position. This is a campaign position, meaning that I'm going to hold on to this position for quite some time. I want this position to develop into a sustainable uptrend where not only this stock, but the group itself and the peers are going to confirm that we are in the campaign mode. And it all starts with phase A, where we see the final climactic action with increased spread, gaps to the downside, huge volume signature that represents both increase of the supply and increase of the demand. Increase of the supply from weak hands and increase of the demand from strong hands. And I will teach you how to identify those two categories of traders, and on the price action and the volume action. And then multiple tests, which I'm putting into phase A. And then phase B was very interesting. The whole selection for this trade was based on phase B. And somebody might be thinking, who knows Wyckoff methodology, what the heck? What is he talking about? How could you define a selection based on phase B? Well, look at where phase B is residing. It's residing on the top of phase A and early phase B. Also on the top of the potential preliminary support, which happens before the climactic action. What does it tell you? Well, it tells us one thing, that institutions bought into this position, and then they didn't want to get rid of it. And the shakeout has specific characteristics that we will study. And this shakeout happens so fast, it doesn't produce a lower low relative to the climactic action. It's actually a high low. And look how quickly there is, after the capitulation, which is still institutional capitulation, they are thinking in terms of the quarters. So multiple quarters The stock is not showing absolute return, and the stock is not showing relative return. What are they going to do if the stock starts to go down? They will get rid of it. They will get rid of the stock from their portfolios. And this is exactly the volume signature and the price behavior that tells us that story. So out of this, we have a relatively quick recovery, which tells us that this was just an kind of institutional short-term capitulation where a lot of other institutions actually picked up all of their shares. And we're seeing multiple tests. By itself, this low is a test to the previous lows in phases A and early B, then multiple local tests, and my point of entry actually was right here. So what am I seeing here? Well, I'm thinking that from this point on, we probably gonna just go up into a potential sign of strength, into phase D, meaning that we're expecting the price to overcome all of the levels of the previous resistance. And then it doesn't happen right away. There is a smaller shakeout. And, one of the things that, we study is that type of the behavior. When you identify the character of the stock as to how it moves, how the price moves, and obviously that's all being based on how institutions are behaving or how weak hands are behaving. And this type of shakeout is to be expected, as we have seen before this type of the behavior. So you should not be extremely concerned until the price actually hits our stop loss, which is below the May low. So I'm still in this position, even the local shakeout is happening. I see positive actions here where there is a quick reversal of the low where there is some value, and then there is a test. So that looks great. Add to the position here, I just missed that, but wanted to have a confirmation. I wanted to see a positive position before I start adding to the position. So I let this rally run, but this rally was really great. It showed to me that indeed, this is the stock that is worth my attention. And the Wyckofian structure is concluding. We are in the potential phase C, and we have the rally that has a lot of momentum. And remember, guys, from conventional technical analysis, momentum always will precede price. Quickly losing my voice in New Year. The next shakeout or shakeout type of reaction is all market related. It's not stock related, it's not group related, it's all market. Volatility of the market takes even the leadership stocks down. So therefore, we just need to assess as to what kind of damage the market could do to this particular stock. Again, we are out if our stop loss is being hit. There is no question about that, but it's not. Instead, we're seeing higher low, and we still want to stay in this position. And currently, I'm still in this position. The goal is very long term, but the logic as to how I'm getting in, how I'm selecting the stock, or how I'm getting into the stock, or how I'm going through such a period of volatility is all Wyckofian. It's all of this analysis of staying in, adding to the position, or getting out of the position, all based on Wyckoff studies, Wyckoff concepts. And I kind of would like you to see the benefit, through actual trades of studying the methodology and, developing the skill of visual recognition of all of those concepts. A couple of questions here. Okay, great. I like that the group is active. This means that we're going to have a good cycle. Hold on a second. All right.